Markets are supposed to be chaotic. Prices rise, prices fall, and no single hand is meant to control the outcome. But here's what nobody tells you. Some markets are designed not to discover prices, but to manage emotions. China's stock market sits at the center of that contradiction. To outsiders, it looks volatile, unpredictable, even irrational. To those who understand the system, it looks exactly as intended. This is where the pattern begins. In the early 1990s, when China first reopened equity markets in Shanghai and Shenzhen, the goal was never to create a Western-style free market. It was to create a pressure valve. State-owned enterprises needed capital. Households needed a place to park rising savings. The Communist Party needed growth without losing control. The stock market became a tool, not a referee. Here's why this matters. In most countries, markets discipline governments. In China, governments discipline markets. That inversion changes everything. Prices are allowed to move, but only within boundaries that preserve social and political stability. Not efficiency. Stability. And when those boundaries are threatened, intervention isn't debated. It's assumed. Let me show you exactly how this became visible. In 2014 and early 2015, China's stock market exploded upward. Retail investors flooded in. Margin debt surged more than 150% in a year. State media openly encouraged participation. At first, it looked like a miracle. Then the bill arrived. In June 2015, markets began to fall. Within weeks, trillions of dollars in paper value evaporated. Everyone thought they were safe. They weren't. What followed wasn't a hands-off correction. It was an emergency response. Trading was halted in hundreds of stocks. Short selling was restricted. State-backed funds stepped in to buy shares directly. Executives were banned from selling. Journalists were warned about negative coverage. This wasn't subtle. It was systemic. Here's the mechanism. China's market control doesn't rely on constant micromanagement. It relies on signaling. Investors are trained, over time, to understand where the invisible lines are. When prices rise too fast, warnings appear. When prices fall too far, liquidity arrives. The state doesn't need to act every day. It only needs to act decisively once in a while to reinforce the rules. Not free markets. Managed expectations. That's the distinction. Retail investors dominate daily trading volume, making markets more emotional and more responsive to cues. Institutional investors, many state-linked, provide ballast. Policy announcements move prices more than earnings reports. This isn't a flaw. It's a feature. The danger wasn't what investors saw. It was what they misunderstood. Many assumed intervention meant protection. It doesn't. It means prioritization. The system protects stability, not individual outcomes. Some investors are saved, others are sacrificed. The goal is not fairness. It's order. Here's the trap. A market that suppresses downside volatility can encourage hidden risk. When losses feel capped, leverage rises. When exits feel guaranteed, discipline erodes. The longer control works, the more confidence it creates. And confidence, when misplaced, becomes fragility. By the late 2010s, some analysts began arguing that China's stock market had fully transitioned from a growth engine into a governance tool. Not a mirror of the economy, a management layer for it. Prices mattered less than behavior. Stability mattered more than valuation. And that leaves the unresolved question hanging. If a market is controlled to prevent panic, what happens when panic finally exceeds the system's ability to contain it? Because control doesn't remove risk. It moves it. And where that risk accumulates is the story that only becomes visible later. Control only works while belief holds. That is the limit every managed system eventually confronts. After 2015, China didn't abandon intervention, it refined it. Circuit breakers were introduced, then quietly adjusted. Capital controls were tightened, then selectively loosened. Liquidity tools multiplied. The message wasn't hidden. Volatility would be tolerated. Disorder would not. Here's what nobody tells you. The real audience for these moves wasn't foreign investors. It was domestic households. This is where the pattern deepens. Analysts suggest that China's leadership learned a precise lesson from the 2015 crash. Not that markets should be freer, but that intervention must be faster, cleaner, and less visible. Direct buying gave way to guidance. Public bans shifted to quiet enforcement. State-linked institutions became market makers of last resort. The goal wasn't to stop losses entirely. It was to slow them, shape them, and prevent cascades. Let me show you exactly how this works. Instead of announcing rescues, policy signals now arrive through liquidity injections, regulatory reminders, and coordinated media tone shifts. When sentiment weakens, banks are encouraged to support brokers. When optimism overheats, warnings about leverage appear. This is not daily manipulation, it's environmental control. The market breathes within a managed atmosphere. At first, it looked like stabilization. Then, the bill arrived elsewhere. Retail participation remained high, but long-term foreign capital stayed cautious. Valuations drifted sideways even as the broader economy grew. Confidence became conditional. Investors learned that upside was allowed, but capped. Downside was slowed, but not eliminated. That asymmetry reshaped behavior, not transparency, predictability. That's the trade-off. In theory, predictability reduces panic. In practice, it concentrates risk. When everyone believes the same invisible floor exists, positioning clusters. Leverage rises quietly. Exit doors narrow. The danger isn't a crash triggered by bad news. It's a correction triggered by disbelief. Here's the mechanism again. Markets exist to process uncertainty. When uncertainty is suppressed, it doesn't disappear. It migrates. In China's case, some economists argue it migrates into shadow leverage, property exposure, and off-market balance sheets. The stock market looks calmer because pressure has been redistributed, not resolved. Here's the trap. Stability-first systems age differently. They don't show stress early. They show it late. When adjustment finally comes, it arrives unevenly, sector by sector, region by region, investor by investor. Control delays recognition. Delay increases magnitude. Some scenarios suggest China's approach could continue indefinitely, with gradual adjustments and periodic interventions preventing systemic breaks. Another scenario indicates that prolonged suppression of price discovery could reduce market relevance, pushing capital elsewhere and weakening the very signal the system relies on. Both remain possible. Neither guarantees collapse. Here's why this matters beyond China. As global markets face higher debt, political pressure, and social volatility, more governments may be tempted by this model. Manage markets. Guide behavior. Prioritize calm. It works until it doesn't. And when it stops working, it fails quietly first. The danger wasn't intervention itself. It was the assumption that intervention scales without cost. Control is effective at preventing panic. It is less effective at creating trust. And trust, once lost, doesn't respond to liquidity. So the final question isn't whether China controls its stock market. That's already answered. The real question is whether a market designed to manage emotions can still perform its original function when reality diverges too far from the tape. Because when price and pressure finally meet, the outcome won't be announced by policy. It will be revealed by belief breaking.